right, so let's take a quick look at the daily chart. This is what we were looking for on Saturday or Sunday, I think it was. Before the market opened up, I shared my analysis and I said that we would likely open below this low, gapping down and trading down into this inefficiency here. That's a real liquidity void. And that low here had sell side, and we're going to see how we opened on Monday. We opened below that low at 17,113.25. Traded lower, made a lower low going into the 7 o'clock hour Eastern time in Asia. Sunday night going into Monday. Here is S&P, same thing, lower gap opening. And again, we're going to look at these two lows here. But first, we're going to grade the opening range of this gap here. So this is new week opening gap. Where we opened that range, we graded half of its consequent encroachment. So new week opening gap high, new week opening gap low. This is for Monday's trading, which, yes, it is hindsight. Okay, so just let you know, I shared what I did yesterday. You can see that on my socials. Look at the lows here on NASDAQ on the left-hand side. We have this low and a lower low. While on the S&P, ES made a higher low. So that kind of told me that we probably did enough for at least the beginning of the week, gapping down like this. I'm not going to go so far as to say that's the capitulation that I think is needed for the low to be in. It's just too many things going on. Tariffs are being pulled back. Higher tariffs are being threatened. It's a mess. So it's going to cause a very erratic price action. So your leverage needs to be dialed way back, or basically you're going to get your clock cleaned, meaning smashed. All right, and here is that liquidity void I mentioned on the daily chart for NQ, and look how close it got to it, just above it. That's good enough for government work, right? Again, the divergence between the lows. All right, and then here is NASDAQ over here, and this low in the London session, right below that low here is sell side, and same low respectively to that of the ES, and the market traded down. And we're going to look at this little area in here. But for now, just note that I did not get this entire run up. I didn't want to hold on. I wanted something very easy, low hanging for a target, relative equal highs, and the relative equal highs here. And this high here would have been just as good as it's an upside target without getting any of this. We're going to zoom in on ES first, and I'll cover this. So here's the London session lows that had sell side below it. And here's the buy side liquidity and another form of buy side liquidity right there. Okay, so 8:30 time. That's when the algo will start spooling, even when there is no news. And we have that here. Trades to get the sell side down here. Now, I want you to take a look at this, and I highlight the exit. Okay, so that's why you see it highlighted down here. I'm hovering over top of this arrow, so that way the little exit arrow appears on the chart. So I got out at that buy side here, and I did not get any of that extra run, and it's okay. Admittedly, yesterday I kind of regretted having shown what I did, because it really doesn't support the idea. What I opened the week with was just be careful and don't try to do anything yourself. But I can't take it back. Once I release it and put it in social media, I don't ever delete anything. But I want to zoom in here and walk you through that little area here. So you can see this candlestick here, the down candle, and then the next candle here. That is the very first presented fair value gap of 9:30 to 10 opening range on Monday. So this, and we took out the sell side at the London lows. When price was in this area here, I felt that it was warranted to make a run for the buy side here. Again, I'm hovering over that candle exit arrow, so that way you can see that's where I exited at, and the price matches that there. And not market replay. Besides, I showed the actual closing of the position, so I'm not sure what else I could do. We're going to zoom in on the NASDAQ now. The sell side taken here, the buy side liquidity, and I'm hovering over that arrow to show you I got out above those relative equal highs. And no, I did not capture any of this move here, and I'm okay with that. But let's zoom in here because I want to teach you something in regards to the first position everybody got. So this is the structure here. We have original consolidation, buy side, the market's tanking. It went lower. Early on in the session on Sunday, we had SMT divergence that never got canceled out. So it set the stage for the lows that were formed in Asia on Sunday night. Those are the weekly lows, and we can start looking for sell side to be taken and then reject that and start to look for buy side. Not because we're trying to pick a low, not because I think a low is in. It's just they put an extreme gap, which is what I outlined on Sunday before the market even opened up. So having that expectation of, I'm saying Sunday, aren't I? Yeah, it was Saturday. I put the video up, and then I did a Sunday shotgun X space. So that's what's confusing me. I'm a little tired. But the analysis I gave on Saturday on YouTube, and then I gave a 2.5 hour cheerleading session on X in the form of a space. But we had such a large gap lower, all expected on Saturday and handed to you before it happened. The market tanked and took out the London lows during the opening range. So here's opening range 930, and then trades down into 945, 946, 947. And then this was the first visit to fair value gap. Now, I know some of you think that it's this one. Now, why is this not a valid first percent to fair value gap? You ready? This is your opportunity to pause the video and think about the differences between what I just showed as mine and that one. If you don't pause the video, you're going to jump to me explaining it, and it won't give you an opportunity to think about it. All right, so here's what some of you think was the very first percent to fair value gap. But why is it not a valid first percent to fair value gap? Because you need to look at where it is in proximity to the candles that formed just before it. Watch. See the body on this one? And the body here. And then this one, the only thing it did was trade down and wick through the discount wick of this candlestick, the consequent encroachment. This whole area here is a balanced price range. So if there's a gap that would be formed inside here, that's not essentially breaking away from anything, is it? Because it's still inside of this balanced price range. So the only portion that would be considered a gap would be what? The bodies, or this body to this candlestick. There's no gap there. There's no imbalance here. All this is reflecting is it's leaving this balanced price range with all of this back and forth. And think about it this way. This candle opened up here, traded all the way down to that low and closed there. The next candle opens exactly where the previous candle closed. Then it trades up. And then the next candle, we open here, do a little bit of movement up, and then trade down to that low, and we stop here. We've had range delivered here in the majority of what this would be viewed as a fair value gap with these candlesticks. And this one went lower. So it's not accurate to call this an inefficiency. It's not. It's part of this larger range that's been traded back and forth. And then when we get this candlestick here, this is actually a gap from this low to that low. So look at the real inefficiency here. And there it is there. Now I'm entering rate, the consequent encroachment of that there. So there's the difference. I hope you found it insightful. Until I talk to you next time, be safe.